Everyone, welcome to P-Bolic Notes. Today is February 17th, 2022. My name is Michael Kirkjian, and welcome to my channel. Today's topic is something that I think affects all of us. It's something that really is very close to my heart. And I'd like to show you the charts of the 10-year Treasury notes and also compare it to the money supply. And because right now there's been a lot of talk, obviously, with the Fed meetings in the U.S., always the risk of the federal chair increasing the interest rates, and now they've announced something like maybe potentially a 50-point basis hike over next next couple of months, or maybe potentially even 100 points. And then this has obviously caused issues with the stock market, the cryptocurrencies. I see in our industry also, where we do commercial real estate, we've noticed that all of a sudden the borrowing costs have gone significantly for the borrowers over the last couple of months. All of a sudden, when they used to be able to borrow on 5-year interest rates at the range of maybe let's say at 2.2%, 2.3% for the insured mortgages, now all of a sudden they're looking at something in the range of 3%. So that's horrible, because for them all of a sudden their cost of the debt has gone up from 2.2 to 3. So that's a 20-25% increase, which is a lot. And obviously this has had a negative impact on the stocks, on the NASDAQ. And also we've also seen there's this seems to be this great correlation between Bitcoin and also the technology stocks. So then we see when they start going down, all of a sudden Bitcoin starts going down as well. I'd like to share with you my computer screen and see what I'm talking about over here. Before I get started, I just to let you know that this is not financial advice. I'm not a financial advisor. I'm just kind of sharing with you what I'm doing in my business, what I'm doing also in my crypto space investments, and I also invest in real estate as well. And please, whatever I talk about today, take it with a grain of salt and do your own research and verify with your own advisors. As I share with you my computer screen, I will show you what is going on the charts. So if I look at the 10-year Treasury yields, I've gone back. So this is what I've done. I have two different charts I'd like to show you. The first one is going to be the money supply. And on TradingView, this goes back to 1981. And what I've done is that then I also put, at the same time, I also put what's going on with interest rates. So if you look at the interest rates, and myself, what I did is, as far as going back, I like to kind of compare 1980 to 1990, 2000, 2010, 2020, and to today, to January 2022. So if I look at what the interest rates were in, let's say, at 1990, so interest rates were hovering, and this was obviously was the 10-year Treasury yields, which has it's not going to be exactly the same for, let's say, the 1-year rate, or let's say the 5-year rate. But it does give us a good idea of where things were and so forth. So if I go to 1980, we see that where things were interest rates wise, it looks like it was hovering at something in the range of around 12.5%. Then there was this massive drop to 9.5%. And then all of a sudden there was a spike to the range of something in the range of approximately 15%. So going from 1980 to 1981, I mean, this is astronomical. I mean, it went from going from 12% to 9.8%, and then 15%. So obviously, this is not a stable time. And then as I fast forward 10 years to around 1990, we see that all of a sudden it seems to have come down quite a bit, right? So then all of a sudden we see that in 1990, the 10-year Treasury yield was something in the range of around 8%. Again, and then you see this just drop, and all of a sudden the spike. And then as I fast forward to the year 2000, which is kind of coinciding with our YTK, and obviously 2001, September 11, that had a massive effect on the entire world. But we see around 2000, 2001, we see that interest rates were kind of hovering also around 6% for the 10-year Treasury yield. And as I fast forward to 2010, it looks like things kind of stayed over here from 2000 until 2010. There was another drop. So all of a sudden, we're in a range of around 3.8%. But it wasn't, let's say, a massive instability, because you went from, let's say, 6.6 and to 2010 around 3.3, 3.4, and so forth. So that's obviously it's a drop, but it wasn't as astronomical a drop as it happened the prior years. And then as I fast forward to 2000 and let's say 2015, 2016, we see that it's hovering now at 2.15%. We fast forward to April and March 2020. This is when COVID-19 happened. And then we saw that all of a sudden the 10-year treasury yield was down at 1%, right? Approximately, and even less, 0.6%. Now today it's hovering at around 2%. So obviously, if someone's investing a 10-year treasury yield at 2%, when they're announcing inflation at 6, 7%, it doesn't make any sense because you're basically losing 5% investing for a 10-year treasury. But I would like to kind of compare this with the actual money supply, and just to see how things, the way they are today, they're not at all like the way they were in the past. And I will show you, I will let the chart speak for itself. This is the M2 money supply from TradingView. And this is a beautiful chart. It kind of shows what the money supply was. So you see here, this thing has been going straight up. And if I look at what it's gone from around 1980 to, let's say, to 1990, so in those 10-year time window, it's gone up something in the range of, the money supply has gone up by around 100%. So it's doubled, really. And then if I go from 1980 to 2000, I mean, really, if I'm making 1980 my base, and if I fast forward to the year 2000, all of a sudden the money supply has gone up by approximately 200%. So meaning that whatever it was at initially, it basically had, initially whatever you had, all of a sudden, if you had $1, now you have $3. So if there's that much money flooding the marketplace, obviously asset prices go up, stock prices go up, real estate values go up, everything goes up. So what that means is that if I went to my 10-year chart, and if I went from the 1980 period, which was hovering around 10%, to the year 2000, which is all of a sudden hovering at 5.2%, it kind of makes sense. It kind of makes sense that the interest rates, if you have so much money supply, the interest rates had to be lower, I believe. Even though they would say, well, look, it's inflationary and money has been printed. So in order for us to have to make sure that there's no inflation, we have to kind of make sure that there's higher rates to kind of offset this inflation. But the reality is that if there's more money available, if people are borrowing more, and if all of a sudden they are having higher mortgages, higher debt, they can't afford to pay the same interest rates. Really, they will just go bankrupt. So to me, I mean, logically speaking, it does make sense that the interest rate dropped as money supply went up. And if I go back to this chart, and if I see how things went from 1980 to the 2010, all of a sudden the money supply looks like it went up from the t equals 0 to 2010. It's gone up by 433%. So that's a 433% increase in the money that was printed. So just imagine what this did to the cost of anything, to the cost of goods, to the cost of services. Payrolls didn't follow this exact same ratio. So meaning that our cost of living went down, even though asset price went up and real estate values went up. So that's why, and if I do this exercise all the way till today, okay, we see that from going back, this a period of 42 years, all of a sudden the money supply that's been printed has been an increase of 1,288%. So this is massive. And really, in order for our economy to work, they can't stop the printing. I mean, the governments of the world, the way our current system works is that they cannot stop the money being printed, because or else all of a sudden there wouldn't be enough money to pay off this debt that's out there. So that's why the way I would see this is that if we're investing in stocks, if we're investing in cryptocurrencies, or if you're investing in real estate, these are real assets. These are going to be good, because then as the money is being printed, the prices are going to be increasing, because now all of a sudden there's going to be more cheap money chasing the limited supply of assets. So that's why I like investing in real estate, and that's why I also really enjoy investing in cryptocurrencies as well. And it's not all cryptocurrencies, because not all are the same. And so the ones that I personally like, which are the blue chips, are Ethereum and Bitcoin. There's also there's over 10,000 tokens out there for cryptocurrencies, and obviously you can do your research, because they're not all are the same. Some are going to have obviously more parabolic runs versus these two blue chips, just because when their prices are lower, the market caps are lower. As the price doubles or triples for these smaller market caps, the return will be greater for the investor. But obviously they could be also more risky in actual investments. One way you could check is there's an excellent website which is called CoinMarketCap. And on CoinMarketCap, when you go look at the specific token that you're looking at, it's going to show you if there's a max supply for it. Like, for example, here's one example, which is Bitcoin. Bitcoin has a market cap of $772 billion, and it's got a token price today of around $41,000 US. And here it says that the max supply is 21,000 Bitcoin. So that's why this is a very good asset, because as somebody buys the Bitcoin token, you know that it's set in the max supply. So that means they can't be creating more Bitcoin. So all of a sudden it's limited to what's already in place. And you can go to look at a lot of tokens that they're all here on this website, and you'll be able to see if there's any other ones that you'd like to invest in, and then you can figure out if it's a fair bet, and also if there's a max supply. I like seeing max supplies in a token, so that this way it's not going to be one of those things that they can just create new ones as they go along. So I'm glad that you watched this video, and this is something that really affects all of us. And I think TradingView gives us these great charts that we can take a look at, and in order to kind of understand what's going on with everything around us, because the money supply really affects every single one of us. Thank you so much for watching, everyone.